All right, welcome. In the next few minutes, we're not just going to talk about saving a little tax here and there. Nope, we're going to build your personal financial playbook for 2025, one that's designed to create some serious long-term wealth. Now, before we jump in, a quick heads up. All the deductions we're about to cover are mainly for those of you who choose to stick with the old tax regime. Got it? Let's go.
So let's just kick things off with the one question that pretty much every salaried person in India has asked themselves at some point. Are you paying way more tax than you actually have to? And just as importantly, are you missing out on building real long-term wealth in the process? Because the real cost isn't just the money that leaves your bank account for taxes today. It's the future wealth you could have been building with that same money.
Okay, first up in our playbook is what I call the growth play. This one's for everyone looking to really maximize their returns while they save tax. And we're talking about the Equity-Linked Savings Scheme, or ELSS.
3 years, that's the number you really need to remember here.
Why?
Because ELSS has the shortest lock-in period of any tax-saving investment out there, just 3 years.
Now, just to put that in perspective, compare it to something like the Public Provident Fund, which has a 15-year lock-in. That 3-year flexibility with ELSS is a total game changer, making it perfect for those medium-term goals, like a down payment on a house in a few years.
And here's where you can really see the growth part of the play in action. Because ELSS invests your money directly into the stock market, it has the potential to give you much higher returns over the long haul compared to safer fixed income options like a PPF or a bank FD.
So what you get is this really powerful package deal. You get a tax deduction of up to 1.5 lakh rupees. Your long-term capital gains can be tax-free up to a certain limit. Plus, you get the discipline of a systematic investment plan, or SIP. And the best part, it's all managed by pros.
All right, let's shift gears to our next play. This one's a true powerhouse for your retirement years, the National Pension System, or NPS.
Now, this is where NPS is an absolute superstar. It offers a unique 3-layer tax benefit that no other instrument has. So think of it like this. Layer 1 is your standard ADC deduction. Then you get a bonus layer, an extra 50,000 rupees just for NPS. And for the third layer, your employer's contribution is also tax deductible. It's a triple win.
When you add all 3 of those layers up, especially if you're a higher income earner with an employer contribution, the potential for tax savings is just massive. I mean, in some cases, these deductions can make up to 13.7 lakh rupees of your annual income effectively tax-free. It's huge.
Okay, now for the bedrock of your financial plan. This is what we call the stability play, and it features 2 of the most trusted, risk-free options out there, the Public Provident Fund and the Employee Provident Fund.
First things first, let's quickly decode a key term you'll always hear with PPF, EEE. It stands for exempt, exempt, exempt. And what that means is the money you put in is tax-exempt, the interest you earn on it is tax-exempt, and the final amount you get back at maturity is, you guessed it, completely tax-free. Now, these 2 work together like a perfect team. Your EPF is like forced savings. It's automatic, it comes out of your salary, and your employer matches it, which is basically an instant 100% return on that part. Then your PPF is what you contribute voluntarily to get that same amazing, risk-free, tax-free growth. It gives you a lot more control. Our fourth play isn't just about growing your wealth, it's about protecting it. This is all about building a solid financial shield for you and your family.
So, with Section 80D, you can claim deductions on your health insurance premiums. We're talking up to $25,000 for your own family, and then you can get an extra $50,000 if you're also covering your senior citizen parents. That means you could secure up to 1 lakh rupees in deductions just by protecting your family's health.
And this right here is the powerful dual benefit of insurance. You get an immediate tax break right now, today, while at the same time building a safety net that protects your family's financial future from any unexpected medical emergencies.
So we've looked at all the individual plays. Now it's time to put it all together. Let's build a winning game plan that's actually tailored to your stage in life. Look, your strategy needs to grow and change as you do. When you're in your 20s, you've got time on your side, so you can afford to be a bit more aggressive and focus on growth with things like ELSS and NPS. Then, in your 30s and 40s, as your responsibilities grow, you start to balance that growth by adding in the stability of PPF. And as you get closer to retirement, your priority naturally shifts from growing your money to just preserving it.
But the single most important factor in all of this It isn't which specific fund you pick. It's when you start. Like the old proverb says, the best time to plant a tree was 20 years ago. The second best time is now. The magic of compounding needs time to do its thing.
And of course, please remember, while this playbook is a really powerful guide for 2025, it's always a good idea to talk to a financial advisor who can help tailor these strategies specifically to your personal situation and goals.
So, there you have it. That's your playbook. The financial year is ticking away, and the strategies are pretty clear. The only question left is, which play are you going to make first?